Hello and welcome to AI Market News by LM. Okay, let's dive into this week's most dramatic market move, where we're going to decode a massive reversal in one of the world's most watched currencies, the Japanese yen.
So on January 23rd, it's like something just snapped. The dollar-yen exchange rate, which had been grinding higher and higher, suddenly just fell off a cliff.
I mean, this abrupt shift left a lot of traders just asking, what just happened? The move was so sharp and unexpected. So let's piece together the clues and figure out what really caused this thing. All right, so to really get what happened with the drop, we've got to first look at the pressure that was building up in the market. You know, this tension, it didn't build overnight. It had been escalating for weeks. Right after the Bank of Japan's press conference, we saw that first sharp drop in Tokyo as the rate was pushing that critical 159 level. But the real shocker, that came hours later. A second, even bigger plunge happened during the New York session. And get this, that's a time when you typically expect things to be quiet on the Japan front, so it caught everyone off guard. And we have to understand, this wasn't just some random market move, nope. It was a direct response to some pretty serious warnings. For days, Japanese officials had been using this very specific phrase, saying they were watching with a high sense of urgency. Now, in the world of central banking, that is not just talk. That's a huge signal to traders that a line is about to be drawn in the sand. So what was the final trigger? Well, as we dig into the information, the evidence points to something more than just a simple action. It was a coordinated one. And that brings us to something called a rate check. So what is a rate check? Well, think of it as the first major warning flag. It's how officials can show they're not happy without actually having to spend billions on a full-blown intervention. They literally just call up the big banks and ask, hey, what's the price on dollar-yen right now? That simple question sends a super powerful message. We're watching you, and we are ready to act. But here's the real kicker, the thing that made this whole event so significant. It wasn't just the Bank of Japan making those calls. Nope. Market participants reported that the calls were actually coming from the New York Fed. And that immediately told everyone that Japan was not acting alone. And this quote from Bipan Rai at BMO Capital Markets just nails it. A coordinated signal from both the US and Japan, that carries way more weight. It tells the market that, hey, both of these major players are concerned about the yen getting too weak, and it definitely makes speculators think twice before they try to push things any higher. And this difference between a warning and real action is absolutely critical. We didn't see a full-on intervention, right? That's when they're actually in the market, selling dollars and buying yen with their reserves. What we saw instead was a powerful warning shot. It's a really strategic move, and it might just be the prelude to direct action if the yen keeps getting weaker. Okay, so a huge move in the yen is one thing, but the big question is, did all this volatility spill over into the broader US markets? The impact on the currency itself was immediate and, wow, really dramatic. The yen strengthened all the way to 155.63 against the dollar. For a major currency pair like this, a move of that size in just one day is absolutely massive. It's a really significant shift in the market dynamics. But despite all that drama in the currency world, US stocks were kind of a mixed bag. The S&P 500 and the NASDAQ actually finished a little bit up, but the Dow was down. So what does that tell us? It shows that, at least for now, all those worries were pretty much contained to the foreign exchange markets. So to get a better sense of whether this currency drama created a wider panic, we can look at some cool sentiment indicators, like the Fear and Greed Index. This index is super helpful because it pulls together a bunch of different factors like market momentum, volatility, all that good stuff into one single score. And what we saw was that even though the yen's move caused this huge spike in currency volatility, the bigger picture, the overall sentiment stocks, stayed pretty stable. That suggests the panic really didn't spread. So, the warning shot has been fired. The question now is, what happens next? All right, looking ahead, if we check out the economic calendar on investing.com, the next week is just packed with really high-impact US data. We've got the big ones, the jobs report, the CPI inflation numbers. These are going to be super critical because they heavily influence what the Federal Reserve does, and of course, that directly impacts the dollar's direction. And we can keep an eye on tools like the CME FedWatch to see how the market's expectations for Fed policy are shifting in real time. Any big surprises in that upcoming data could cause some major swings. And not just for the dollar, but across pretty much all markets. And that leaves us with the big, lingering question, right? Was this coordinated warning shot a real game changer? Was it powerful enough to finally break that relentless trend of selling the yen? Or was this just a temporary pause in a much, much larger battle between the world's central banks and the market? This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.